Imagine this. A 25-year-old guy gets his first salary. Within 6 months, he has an iPhone on EMI, bike on EMI, laptop on EMI, credit card bills, a vacation paid through buy now, pay later. On Instagram, his life looks rich. But in reality, he has less than 3,000 left in his bank account by month end. And the scary part is, he's not alone. Today, millions of Indians are trapped in something that looks like financial progress, but is slowly making them poorer every single month. This is the story of how EMI culture took over India, and why companies, banks, apps, and even social media want you to stay in debt forever. A generation ago, Indians feared debt. Our parents bought things only after saving money for years. Want a TV? Save first. Want a scooter? Save first. Want gold? Save first. Middle-class families believed one thing: if you cannot afford it today, don't buy it. That mindset created financial discipline. India traditionally had one of the highest household savings rates in the world. According to RBI data, Indian households once saved over 23% of their disposable income. But then, everything changed. In the early 2000s, banks discovered something powerful. Indians may hesitate to spend 1 lakh at once, but they don't hesitate to spend 2,999 per month. That changed consumer psychology forever. Instead of selling products, companies started selling monthly affordability. And then came zero-cost EMI, instant loans, credit cards, buy now, pay later apps, one-click financing. Suddenly, expensive products felt cheap. An iPhone no longer looked like 1.5 lakh. It looked like only 4,999 month. That word, only, changed India. Today, almost everything is available on EMI. Phones, watches, furniture, bikes, luxury bags, even groceries in some cases. India slowly shifted from a saving economy to a consumption economy, and businesses loved it, because debt makes people spend far more than they normally would. Here's the dangerous part. EMIs create an illusion of affordability. Let's say someone earns 50,000 per month. Now imagine this: phone EMI, 4,000, bike EMI, 5,500, personal loan EMI, 7,000, credit card minimum due, 3,000, furniture EMI, 2,500. Individually, none of them feel huge, but together, identity, that person is financially trapped. This is exactly how EMI culture works. It divides one massive expense into smaller emotional pain points. Psychologists call this payment decoupling. Your brain stops feeling the true cost of the product, and companies know this very well. That's why luxury brands, smartphone companies, and FinTech apps aggressively promote monthly payments instead of total prices. Because humans focus on short-term comfort, not long-term consequences. Now let's look at the numbers. India's personal loan market has exploded in recent years. According to RBI and financial industry reports, credit card debt in India crossed 2 lakh crore. Personal loans have grown at record speed. Buy now, pay later uses exploded after the pandemic. Young Indians under 35 are becoming the biggest borrowers. And here's the shocking part. A large percentage of these loans are not for assets. They're for lifestyle spending. Phones, travel, fashion, dining, luxury experiences. People are borrowing money for things that lose value immediately. That is financially dangerous, because debt is useful only when it creates future income. For example, education, business expansion, productive assets, home loans in some cases, but borrowing for lifestyle inflation, that creates fake wealth. Instagram completely changed spending behavior. Earlier, people compared themselves with neighbors. Now, they compare themselves with influencers, celebrities, and rich entrepreneurs online. Every scroll tells people, you deserve a better life. Luxury vacations, latest gadgets, premium cafes, designer clothes. And EMI became the bridge between desire and reality. Even if someone cannot truly afford a lifestyle, EMI allows them to temporarily imitate it. This created a dangerous cycle. See luxury online. Feel pressure. Buy on EMI. Repeat. A report by several FinTech companies showed that Gen Z users are increasingly comfortable taking loans for consumption spending. Why? Because debt has been normalized. For many young people today, EMI feels as normal as paying electricity bills. And that is exactly what financial companies wanted. Here's something most people don't realize. Debt is one of the most profitable businesses in the world. Banks earn from interest, late fees, processing fees, penalties. FinTech apps earn commissions. Retailers sell more products. Credit card companies make billions. In fact, many businesses today depend heavily on financing. Without EMI, sales would collapse. Think about it. Would luxury smartphones sell at the same level if everyone had to pay full cash up front? Probably not. EMI artificially increases purchasing power. And when millions of people start spending future income today, the economy grows faster temporarily. But households become financially weaker. That's the hidden cost. Let's take a real-world style example. Darshan is a civil engineer in Kochi, earning 50,000 per month. Sounds decent, right? But here's his monthly reality. Personal loan, EMI 7,500, rent 6,500, gold loan, EMI 5,000, credit card payments $7,000, AirPod EMI $4,000. By the end of the month, he has almost no savings. Then one emergency happens. Car repair, phone repair, medical report charges. Suddenly, the entire system collapses. This is happening across urban India. People look financially stable from outside, but internally, they are surviving paycheck to paycheck. And the worst part? Many don't even realize how trapped they are. Now here's the interesting twist. Rich people also use debt, but differently. Middle-class people often use debt for consumption. Rich people use debt for investment. There's a huge difference. One buys liabilities, the other buys assets. For example, a business loan can generate income. A productive investment can appreciate in value. But a phone bought on EMI, its value starts falling the day you open the box. That's why financial literacy matters. Debt itself is not evil. Wrong debt is the problem. India is becoming one of the world's biggest consumer markets. That's great for economic growth. But if financial literacy doesn't grow alongside consumption, millions could remain trapped in debt cycles for decades. Schools teach algebra, but not credit scores. People know smartphone specs, but not compound interest. And that's dangerous in a credit-driven economy, because one bad financial habit repeated for years can destroy long-term wealth creation. EMI is not always bad, but when EMI becomes a lifestyle, it quietly steals your future income. The real problem is not buying expensive things. The real problem is buying things to look rich, while becoming financially weaker every month. Because true wealth is not about what you show, it's about what you own, without owing someone else. And maybe, the richest person in the room is not the one driving the luxury car, but the one sleeping peacefully, without debt. If you enjoyed this video, subscribe to the channel for more business case studies, money psychology, and stories behind modern consumer culture. And comment below, what do you think is the biggest financial trap in modern India? See you in the next one.